Okay. So we said entry point is the price at which we execute our trade. So either you're using an instant execution, that's entering at the current market price, or you are using a pending order where you need to specify your own buying or selling price. Is as long as that market has triggered, you're in the market, that is your entry point. Now, the next parameter you need to define before you execute a trade is your stop loss. And your stop loss is like a pending order. I think someone asked me last time. Stop loss is also a pending order in the sense that you put a stop loss waiting for price, pending for price to come there and take you out. Now, a stop loss is a price that takes you, or is an order that takes you out of the market with the minimal loss you want to take from that market. With the minimal loss you've planned, or you've budgeted, or you have agreed to take in that particular trade, in that particular market. That's what stop loss does. Stop loss, stop my loss, stop your loss. It's a stop loss order. So it's the another order that closes your trade or your position with the minimal loss you are willing to lose in that particular trade. Likewise, take profit. Take profit closes your trade, but this time around it closes it out with profit, with your profit targets. So these stop loss and take profit are types of pending orders, but they close you out either in a loss or in a profit, depending on what you are willing to risk in that market, and also depending on your profit targets. Now, these are the three parameters you should define before you enter a trade. If you've not seen reason to define your stop loss parameter and your take profit parameter, then you should not be in that trade. Please mark this and note this and write it down somewhere. If you've not seen reason to define your stop loss parameter, that is what you are willing to risk in that trade, and to define where you want to take your profits as the market starts, then that is not a good trade for you. Because these three parameters are things you should define in the market. And what helps you define these three parameters is the market swing. Let me share my chart. The market swing. Okay. Now this is Euro USD. Euro USD on H1. Now this is H1. I believe in our last class we discussed something about support and resistance. Now you can see this market is ranging on this zone. This is on H1. If we switch to daily time frame, we discussed time frame last time. Now, if we switch to daily time frame, this is exactly what I just drew on H1. And this is an example of a double bottom. A double bottom, in the sense that price has been here initially. Look at it. Price has been here initially. Then It rallied up, it went up. My green candle is my buying candle, my red candle is my selling candle. Now, price came back to this bottom. Price has returned back to this bottom. Now, there is every possibility, if not for fundamentals and the geopolitical tension, which is giving you more strength to USD, even though I think USD should have a very important news this week on interest rates. We know what happened to Russia. They even had to hike their interest rate to 20 basis points, all the way from 9 to 20 rates. That's Russia, but that's by the way. Why? Because of crisis. Now look at, if not for geopolitical tensions, this is Euro USD. Technically, now let's assume there is no fundamental playing out on this market. Technically, we said, since this has behaved like this on this zone, now price has come back to this zone. This is the second. This is price again. Now, this is an example of a double bottom, to trade a double bottom. And we said, to trade a double bottom, you are entering at any price around here. Now, look at what price did. It came to the bottom of this range. This is bottom of this range. It has touched it. This is with a wick, right? So if I'm buying now, I should buy anywhere around here. If I'm buying anywhere around here, I will have to calculate if this support is called a support level. Now, if this support refuses to hold, where will I take my loss? If this support did not hold, that means if price did not push up from here, based on the past action. Okay, if you draw this back, you see that this is happening around this region. That means it's a very strong region based on this time frame. It's happening. Price has initially reacted around this region. Let me use our currency, for example, those in Nigeria. Okay. Currently is at 580. Now, we can see this, we can liken this to when price was around 450, or okay, let's take it to 500. When price was around 500. Now, price went to 580, and now coming back to 500, there's every possibility that price will move up again from 500. This is what I'm trying to say. There's every possibility. That means for people that have not bought that didn't buy initially at 500 when price was in 500 before. Now price coming back to 5, even people that bought before, price now coming back to 500. Okay, they will want to buy at that level again, anticipating that it's likely to go up again to 550 to 580 or even get to 600. Now that is what the technical method is telling us. Okay. Price has returned back to an initial base that it started from. Okay, so we said there's every possibility that price will move above that. Now, if you're buying this at that 500, you can say, okay, I will use 450 as my stop loss. Now I'm saying if price comes back to 500, goes below 500, goes to 490, 480, 470, 460, I will still be in that market. But as long as it goes below 450, I'm exiting that market, because I'm taking my range to be from that 450 to 500. If it goes below 450, I'm exiting that buy, in the sense that if it goes below 450, can get to 400, 350, and start ranging around 350. Now that is my range, that is my stop loss. I want to use 50 points as my stop loss. I'm entering at 500. Once price goes below 450, I am exiting that market, because based on technical analysis, if it goes below 450, there is every possibility that it will go below 400 to 300. So I will exit the market at 450. Now that 450 points or that 450 will be your stop loss value. Your stop loss, remember, you entered at 500. So you need to place a stop loss below that your entry point. Below that your entry point. Let's take, for example, for yourself. Let's say this happened. Now, what is happening at that bottom is almost what is happening at this top. This is an example of double top. Okay. Now, this happened and price, look at it, price dropped from here for days. This is daily time frame. After some days, it came back to that top. It came back to that high. And we said technically, in forex trading, we say we sell at a high, we sell at a resistance and buy at a support. This is seen as a low. And this is based on this time frame, right? So we said, okay, when price comes back to this range, I will be selling. Now, if I'm selling from this top, we're saying that if price refuses to sell from this level and starts trending up, I will exit. Now, you need to look for price anywhere. It depends on some people. That's where psychological numbers come in. We teach you psychological numbers in your intermediate class. So you look for, you remember anywhere in these charts have price. You look for a perfect price around there, not so perfect, but like a psychological number around there. You put in your sell. Now you're saying if price goes above this level, then this level above your entry point or entry region should be your stop loss. So if it decides not to sell here and goes above this level, then it should take you out with the minimal loss you are willing to take. I always tell people trading is an investment. If you're investing $5 for a particular trade, depending on what you have in your account, then you should say, if this market goes beyond $5, I'm exiting this market. But I'm risking this $5 to gain or to earn $20, $25, $30, depending on your risk to reward ratio. So in this market, that's the only way to make profit. In this market, you need to risk something to gain something. I don't know, maybe that's why people think that it's too, it's kind of risky, maybe because you need to risk something. But generally in life, I think that's what life is actually. You actually need to risk something to gain something in return. Whether you're working, whatever you're doing, I just feel that's the general ideology about life. You need to risk. So that is how it is in forex. If you're saying I'm putting this at risk, I'm putting my $4, my $5 as risk. Okay, I'm risking $5. But if it goes in my direction, I will earn $30. That is how it is in the market. So that stuff you are risking is your stop loss. Now, what determines where you place your stop loss value depends on where you're entering the market. Depends on where you're entering the market. You can't enter market as where it is now, which is, we've already identified this as our support region here. We've already identified a double bottom. We said we are entering here. Then you are now using far away from this place as your stop loss. That would be too far. That would be too much a risk. That would be too much a risk. So what determines your stop loss is the point you're entering the market, and also what you're willing to gain from that market if it moves in your direction. If it moves your direction. Now it's obvious that if market breaks this level. What I mean by breaks that level is if price goes below this level and do what we know as a retest. And do what we know as a retest, but especially if this news continues, if this panic continues, that means this is what we'll be expecting. The next area we'll be expecting to buy will be this region. The next area we'll be expecting to buy will be around there. That means obviously price is coming back to this region. So if it refuses to buy around here, right, and this happens, that means it will come for a retest. Now, turning this initial support to a resistance. Turning this initial support, this is not currently a support, but if it breaks it, it will turn this initial support to a resistance in the process of retesting for price to come back to this other low. So people, now this is low. This is lower than this other price. So everything depends on where the current market price is. Current market price now is here on this bottom, but we're saying if you break this bottom, it will come for a retest. At this point, we can start selling from this region to come back, for price to come back to this level. So if you decide to sell here, if this has happened, you decide to sell here, you put your stop loss just some pips below that region you are selling. Then once price approaches here, you take your profit, but that's for another day. Like I said, your entry point is the price at which you enter the market. Then your stop loss is what you're willing to risk in that market based on points. Now your point is multiplied by your stop your lot size you use. You know what the amount you're risking in a particular trade. Then your take profit is your target profit, what you want to gain from that market. That is the 3 parameters you really need to define before you enter the market. Okay, the next on this slide is PIP and pipette. Now, PIP is seen as the PIP is seen PIP. It said percent. I'm trying to admit people. Okay, it's seen as the measurement that expresses the change of value, the change in the value of the market. Okay, percentage in points. It expresses the change in the value of market. That is what PIP is defined as. What we mean is that is the price movement. Now we remember talking about exchange in price movement, right? Price volatility, price changes, because price is not fixed. We are trading a volatile market. That means the price is always changing. Now the amount changes. The smallest fraction, the smallest movement in price, is what we know as PIP. The smallest movement, as you buy from, maybe you buy from 100, it changes from 100 to 200. That means it has made 100-point move. Now that extra you bought from 100, which is your entry point, which was your previous market price or previous price where market was. It was at 100, you bought at 100. Now it moves from 100 to 200. That means the current market price now is 200. That means from where you entered to where the current market price is, it has made extra 100 points. It has made 100 points. So that 100 points is seen as a PIP. Though it's normally, because currencies are expressed in 4-digit numbers. 4-digit numbers. So the last number is seen as the PIP, which is the 4th-digit number. You can see on where we have the Euro USD. The one on red is seen as our PIP number, which this will change before it starts reading to 5, 4, and it goes from right to left, right? Now, the last digit after the 4th-digit number is your pipette. The last digit after the 4th-digit number is your pipette, which is the shortest or the smallest number you will see in market calibration. You will see a market calibration. Now, pipette is just 1/10 of PIP. It's 1/10 of PIP. That means pipette will change from 1 to 2, 3, 4, 5, 6, 7, 8, 9. As soon as it starts counting 10, it will add up to PIP. So pipette is the last digit, the one that is always changing. That is our pipette. Okay, we'll just do a little of PIP and pipette calculation. PIP calculation. Let's do Let's look at how we can calculate PIP for a buying and a selling market. Okay, let's say we have someone buys Euro USD. Someone buys Euro USD. Money Matters buys Euro USD at, let's say, 1.24. Okay, then our pipette, let's use to be our pipette. Most times, if it's zero, pipette, if it's zero, is insignificant. Yes, in Dan, you are raising your hand. Do you have any question? If you have any question, mute your mic. And he makes 80 pips profit.
Sorry, it was a mistake. It's a mistake.
Okay, he makes 80 pips profit from the market. Now, what is his take profit parameter? So we said our entry point is 1.25642. Remember, the 2 is the pipette. In this case, it's not 0. If it's 0, it's insignificant. So, but let's use 2 because we know that it will count from 1, 2, 3, 4, 5, 6, 7, 8, 9. Then to now add to pip. So the last number, which is the 5th number after the decimal point, is the pipette. Then the 4th one, this is what starts the pip. Then all of this. Now we said this is the entry point for a buy. And in that buy, he made 80 points or 80 pips in that market. Now, where is his take profit parameter? Now, this is what, for a buy setup, we'll have something like this. Now, we have EP, which is entry point. Now, if he's buying here, is expected, remember, if he's buying, this is his entry point, which is, this is 1.25642, right? So that means this is what he's expecting for a buy. He buys and he expects the market to go. Nobody says market goes up once soon as he enters. No. Okay, but this is what he expects. I don't know how it managed to move, but what I know, it can move in a straight line. It can just move once. Now, before that happened, remember, market was coming from somewhere. Market was coming from somewhere. From now. That means since he was, remember, okay. Well, since he was entering from here, this has been broken and it got retested, maybe created a double bottom. Now he was entering from this level. That means stop loss should be around here. Stop loss should be around here because he's buying. Stop loss parameter should be around here. SL is my stop loss. Then take profit. Since he's buying, it's here. He's buying, so it's expected that when you buy, it's assumed that the price is low. So if it goes up, you make profit. But if you buy price starts coming below, starts coming below the price you bought, that means you are losing. Or if you buy, let's assume you bought at 2, price goes to 10, you are making profit. Or if price goes below that 2, which is your entry price, that means you should be on loss. So they're asking what will be the profit, what will be the price at which he's taking profit, which is here. And what will be the price at his stop loss? I didn't add that, you can add that. What is also his stop loss parameter? Now, for him to make 80 points, that means from here to here, from his entry point to his take profit point, what he made was he had 80-point move, which is your PIP. That's your PIP. From where you entered to where you're taking your profit, you had 80-point move. Okay, that means, let's say the minimum you are using 2:1 ratio. 2:1 ratio. That means for your stop loss, let's assume you are using, from where you entered to your stop loss parameter, let's assume you are using 40 pips. Let's take it for 2:1 risk to reward ratio. Your profit is 80 pips. That means your risk should be 40 pips. 2:1. If it's 2:3, you can use 20 pips as your stop loss. But for calculation purposes, you can start doing other calculation. For calculation purposes, let's use 80-80. Your stop loss and your take profit. 80 pips, 80 pips. So for a take profit, the calculation is simple. All you need to do is add 80 pips, 0.2562. Now you are adding 80 pips to your entry point. You're adding 80 pips to your entry point. That means 80 pips, you will start from, this is your 80 pips. 80, right? Now, the last one is your pipette. The one, because remember, your 2 here is your pipette. So the last one here is your pipette. You just put that 0, you can neglect it. Now, your pip starts from this 4. So, which it starts counting this way. So this 4, you are putting the 80 from this 4, which is your 0.8. Then start counting this way. Then you do your addition. That means here we have 2, 4 plus 0 is 4. 6 plus 8. 6 plus 8 is what's 6 plus 8?
14.
That's 4. Okay. What is this? 4.
Another 4.
Another 4. Really? 5 plus
5
14.
plus 1 is 6.
6.
6. Then 2. After we arrange it,
2.1.
2.1. Sorry. 2. Then 0.1. Sorry, that is 1.2.
2, 6, 4, 4.
No, 5. Abi?
No, 4, 4, 2.
Okay, 4. 4, 2.
2. Then.
Hope you are correct.
No, the other 2 is not.
There's 1, 2. No, the 2s are just 1.
It is 1.12. Sorry, 1.26442.
26442. Okay.
Exactly.
Okay. So this will be our take profit parameter. 1.2
6,
4,
4.
2. Okay, so this is our take profit. That means we entered the market at 1.25. We are taking profits. Now we have 1.26. Now start to leave the remaining. That means price has moved 80 points to where we enter the market. You can see that this is higher than our entry point. That means price has moved from where we entered to a different level. It has appreciated. It has appreciated. We've made profit. We've made 80 pips profit. That's 80 points profit. Now we said if price goes below our entry point, we should be in a loss. And now, should we allow price to keep going below? No. There should be a target loss we should have also. Now, we said for it to be a business, your target loss should be lower than your profit target. That means if you are using 80 point move, your target loss should be like at least minimum, highest 40 point move. So if it's a target loss of 40 point move, all you need to do is just minus 40 from your entry point. Whatever parameter it gives you here, stop loss parameter, which is if you minus 40 around it, you will have 40.
So that is 1.25602.
Okay, okay, exactly. This is what we have. 1 point. That means this will be our stop loss parameter. That means at that point, like what we have here. Okay, I don't have any other entry. So let's assume let's assume for a pending order. This is a pending order.
Sorry, please, how did you calculate the stop loss?
Okay, let me come back. The stop loss, we just did a minus of 40. Since we are having take profit of 80 points, so we just did a minus of 40 points, which is from where we entered to where we want to take our loss. So we minus it from our entry points. It's just like changing this 80 to 40, what we have here. Someone did it, I don't know, but I think it's correct. Just this is 4, this is 0. So minus 40 from our entry point. This is our entry point. You have
okay.
Yeah. So this is our stop loss parameter. Now I was trying to show you charts where you can impute those values.
Sorry. Hello.
Yes, sir.
Please, can I your screen is not showing the calculations again. The first one added the 80 from you excluded that 2. So if I were to do the same to this, this 0 is supposed to be 4.
It's just the arithmetic. I think there's a little mistake there, but no challenge. It's 1.254.
Okay, let's just do it. Just
get the logic and let's continue, please. It's just the logic. You say the pipettes can be neglected.
162.
Yes, whatever it is, just put it there, please.
All right.
Thank you. So now this is for a buying market. Before I go to chart, let me do for a selling market. Now for a selling market, it's the same thing. The only thing is that it does the opposite. For a selling market, you have, let me admit some persons. For a selling market, you have something like this. Also, you have your entry point, right? We have your stop loss and your take profit. The only difference is that for a selling market, this is your entry point. Now, instead of here being your take profit, I was supposed to, okay, here will be your stop loss and your take profit will be down. Your take profit is down. What we mean by this is that it's expected that if you are selling, you're selling a market from a high, just like I was showing you Euro USD. You are selling from the top of the chart. You are selling from the top of the chart. So if price is coming lower, that top can be from the middle. It all depends on your time frame, which we've already discussed, but we'll also discuss it better. Now, If price is coming below your selling point, if price is coming below your selling point, which is your entry point, it's expected that you should be on profit because price is coming below your entry point. Then you take your profit below. So it's the same thing. As long as it's coming below, you still minus it. That means if you entered at 50, if price comes to 20, you made profit. So all you need just minus how many points move you, that is where you entered from. Then whatever price is here is your take profit. But if price goes above your entry point, you're on loss. But at what point loss, you add it to your entry point. Then whatever you have here is your stop loss. So this is for a selling market. This is a buying market. Just the same thing. The only difference is that you are taking your profit down the selling market and your stop loss is up. You're buying low. As price appreciates, you take your profit. Then if price goes below your entry point, take a loss. Then how many points loss is what you decide for yourself. Okay, so let's go to chart. The calculation is the same, just plus or minus. That's just that. Plus or minus. Plus and minus. Okay, so just like I said, this is more like a selling market, right? You sold from the top and price is coming below. You decide where you take your profit. Now we said based on the reaction of price here, if you decide to buy here, right? We are buying here, we should find somewhere and put our stop loss. Now, if we buy here, price starts appreciating, we take our profits up. Why? Because price will start moving above our entry point. If not for fundamental factors, price is already on a buy region. If not for fundamental factors, I would have said if you have your chart with you, whether demo, of course it's demo. If you've downloaded your charts, put a buy on this market and put a stop loss. Use 50p stop loss, know your entry point, use 50p stop loss. Currently price is at 1.1120. That's the entry point. Put a buy, initiate a buy. I can't do it here because my life I can initiate a buy and put a stop loss. But the only but there is just because fundamentals are currently what is moving the market, and strong fundamentals for that matter. Nobody knows if US will join the war or they will not join. If anything happens, this market will scatter for the next time. So fundamentals are just the things moving the market for now. If not for fundamentals, it's on a buy region based on previous support that has been created. So all you need to do is for a pending order, for instant execution, you can enter the trade immediately. Then after you know where you want to put your stop loss and take profit. That's the only difference. For instant execution, you can just execute the trade, place buy or sell. Then after you can come back and put your stop loss and take profit. But for a pending order, remember a pending order, price is waiting to get to that region. So for pending order, you can put your price here where you're entering. Know the price you want to put a pending price for your entry price. Then also come here, know where you want to put your stop loss. Come here, know where you want to type your take profit and be in the market. If you don't want to do with calculation, you can just use the normal technical chart and know your prices. Okay, this was what I thought the moving average during the absolute. Okay, so let's assume this is daily. Let's assume we sold anywhere around here based on these previous reactions. We sold anywhere around here, right? And we said, okay, since we are selling within this region, any price around this region is a selling point. Now, outside this resistance, you can say, okay, I can use somewhere above this resistance for my stop loss. All you need to do is know the price here, even if you don't want to go through the calculation. Just know the price at where you want to put your stop loss. You can trace it to the right. There's a price there, right? You put the price. Now, if where you put the price, if you calculate, you can use your crosshair, calculate from your entry point to where you put the price. This is around this daily chart. This is around, okay, let's say we want to use 100 pips. 100 pips stop loss, which is 100 points stop loss from our entry. To be around this region. This is what this is 110. Remember, we have the second price there. We have the first price on this cross share. We have 7. Okay, we have 7 here. 7 is the percentage move from where you entered to where you are now. That 7 you have. The second one is the pip and pipette, which is 113.2, which is 113 pip, then 2 pipettes. That's what it means. That means the point move or the pip move from where it is, which is, I assume we entered around there, to where the price is now is 113.2. That's 113 pips, 0.2 pipettes. That is it. Then the last one there is the price on that level. The last one there, which is 1.25862, is the price on that level. So you can use that price to set as your stop loss parameter. Then, of course, you know how many points from that level. That is for pip and pipette. Then other examples of base and float currencies. Don't base and float currency. The next one is lot size. The next one is lot size, which is very key to trading. Lot size is key to trading. King Dan, your hand is raised again. Do you have any question?
No, yes, I have a question this time.
Okay, go ahead.
Please, from the PIP you taught us, I want to ask, like, how many pips makes dollar? And then the pips, is it the same for each lot size, or each lot size different pip per dollar?
Okay, so that question, both the first and the second question, will be answered in this topic. Lot size. Okay, so let's just be patient. Both questions will be answered here.
Okay.
So yes, so lot size is defined as a contract used to describe the size of a trading position. The size of a trading position with reference to units of the currency. What we mean is that lot size is what defines the amount. You can call it the amount, you can call it the size, you can call it the quantity of the asset you want to purchase. I will always use this example. When during sometime December last year, MTN sold some units of their shares, right? Now people purchase shares. People bought I think I bought 8 for some units, and that person bought for some units, and just like that. Now it means that unit, how would I put this now? Now, if anything happens to that MTN shares, what determines the amount I will lose is determined by how many units I purchased. Let's say 1 unit is sold for 8,400. Now I decide to buy 10 units of it. That means my profit will be multiplied by the number of units I bought, because 1 unit is 84, right? Now, if I'm making losses too, my losses will be multiplied by the number of units I also purchased. If I purchase 10 units and another person purchased 1 unit, if the person is losing, the person is just losing 84, because that's the amount for 1 unit. Now that 84 is your lot size. That 1 is your lot size. Whereas the person that purchased 10 units, 10 is the lot size of that person. So whatever you purchase based on the units will be multiplied by the number of units. The amount of the 1 unit multiplied by the number of units you purchase will determine how much you will make and also how much you will lose. Now, lot size works in a way, it's like a two-edged sword. If it gives you profit, the profit it would give you is equivalent to the minus or the drawdown or the lot it will give you if it goes against you. That's lot size. So it's the size or quantity or amount or anything you want to liken it to of your trading position. Lot size is defined as the size of the trading position or the quantity or the amount you are purchasing on that asset. That is your lot size. Now, there are three categories of lot sizes. We have the micro lot size, we have the mini lot size, and we have the standard lot size. We have the micro lot size, we have the mini lot size, and we have the standard lot size. Those are the three categories. Now, we said the micro lot size ranges from 0.01 to 0.09. Micro lot size, which is the least lot size in the forex market. I know some persons do with my nano account. Nano account is 0.001, but that one no they give money. But when we explain 0.01, you understand that nano is just like you're selling Accra. Don't do that. So the smallest lot size we have in the forex market or with some brokers is 0.01. So for a micro lot size, it ranges from 0.01 to 0.09. I mean, you have 0.0 to 0.03 and to 0.09. For a mini lot size, it has 0.1 to 0.9. That's for a mini account. And for a standard lot size, it has from 1 to infinity. Now, let's look at the range. Now, that's the range of values. Now, let's look at this. I hope we can see this clearly. Now, it means that this is the lot size, which is 0.01 micro lot size. Now, this is dollar per pip. Now, we said if it makes 1 pip, which is 1 point, if it makes 1 pip move and you traded it with 0.01, what you will earn is $0.1, which is 10 cents. We know that 100 cents makes $1. 100 cents makes $1, right? Just like in Naira, we have Kobo and Naira. So 100 cents makes $1. So if you're trading with 0.01, which is the least lot size, and it makes just 1 point per point move or per pip move, you've made $0.1 or 10 cents. Now, if it goes against you, if it's a minus, you've also lost $0.1, which is 10 cents. Now, that same market, you made 20 pips. 20 pips move. All you just need to do is multiply $0.1 times 20, which is what? $2. 0.1, which is what you make per 1 point move. Now, if you multiply it by 20, you have $2. Sorry, excuse me. Oh? No. Almost. So if you multiply it by $0.1, you have $2. Now, if he makes 40 pips move or 40 point move, Okay, sorry, network took me out. Network took me out. Okay, so this is what we have. We said if you traded it with 0.1, which is a micro lot size, and you made 60 points, 60 pips, all you need to do is multiply 60 pips times 0.1 times $0.1, which is 10 cents. It will give you what? $60. Now, just like that, up to you have 0.01, 0.02, 0.03, 0.04 to 0.09. That means if you traded it with 0.09, and it makes 1 point move, 1 pip move, you just made 90 cents, which is $0.9. The calculation continues, or the mathematics continues. Now let's go to mini account, which is a mini lot size. We start from 0.1. Now 0.1 is $1 per point move, $1 per 1 pip move. That means if you moves 1 pip, you've made $1. 2 pips, $2. 3 pips, $3. 4 pips, $4. Right? So if you are trading with 0.1, a market makes just 1 pip. Remember, these people we are talking about is the market is highly volatile. It does it in twinkle of an eye. In 1 hour candle, if there is much volatility in the market, it can make 100 points. It can make 150 points. It can make 80 points. It can make 70 points. It all depends on the level of volatility in the market. So it's not like the points is something that takes time. No. Market is always changing in price. It's always changing in price, right? So 0.1 trading into 1 point move is $1. 20, if he makes 20 points or 20 piece move, 0.01, with 0.1 rather, that means $1 times 20, $20. If he makes 60 point move or 60 piece move, that means $1 times 60, which is $60. So you follow it like that, 0.1, 0.2, 0.2, around 0.9. That's why we said lot size is what defines if you remain in the market or you, in fact, it defines your life and death in this market. You can't afford to use a big lot size for a small account. That one is about risk management. We'll teach you that one during your risk management class. We'll learn what you should use, the lot size that is suitable for any account size to protect your account, right? So this is it. If you trade with 0.9 mini lot size, mini lot, 0.9 mini lot, that means if market moves just 1 point, you make $9. If it moves against you, minus $9. If you made 60 points with that same 0.9, when another person is trading, is making 60 points and the person is having $52, you that made 50 points, 60 points with 0.9 is having $540, because you are saying $9 times 60. $9 times 60, which is 580. Now, your lot size is 0.9. Now, for a standard lot, which starts from 1. Now, for a standard lot starts from 1, and 1 point move, 1 pip move for a standard lot is $10. It's either 10 in your direction or minus 10 if it's going against you, if it's against your direction. So you know the kind of amount you should have to trade one standard lot in your account. Okay, so once it goes 1 point, is $10. Once it goes 20 points, it's $200. Once it goes 40 points, it's $400. Once it goes 60 points, it's $600. So that is how the lot size ranges from 0 points. So everybody has a place in this market. You say you have small money and you don't have large money to trade a fat lot size. There is a place for you. you operate on micro accounts and just be taking it small, yes, the growth will be very small. The growth will be very small because you'll be seeing cents, $1, $2, $3. That same market that you captured 100 pips, another person is making that same 100 pips and is having over $1,000, depending. Is having over $10,000, depending. But everything depends on the capital you have. In as much as we have leverage that makes us trade, it's only leverage. This is where leverage comes in. Leverage can make you trade an account that you should base on micro account to trade. Now, leverage can make you trade above micro account and start trading mini accounts because you are using something small. You funded $100 and you choose a leverage of 100:200. That means you can trade more positions. So where you're supposed to be trading micro lot size, leverage will make you trade mini lot size. But you should not forget that inside that mini lot size, what your money is $100. So if it moves against you, where you're supposed to trade with 0.1, and for 0.01, you need almost 1,000 pips before you lose that $100. 1,000 pips because it's 0.1 cent, $0.1. But if you are trading that same account with 0.1, all you just need is 100 pips and that account is gone. So you see the difference. That's why if you have a small account, there's a place for you, which is a micro lot size. If you have a fat account, you think you have $20,000 and above, then there's also a place for you to make big money. So the market is determined, the amount you make in this market is determined by the amount you have. Lot size is defined by the amount you have in your trading account. Lot size is defined by the amount you have in your trading account. So every man to thyself, cut your clothes according to your size. That's how this market operates. If you have fat accounts, you can trade and make good profits. If you, of course, the first thing first is knowing the technical skill, having the technical skill. Okay, that is the first thing. Even if you have so much money and you don't have that skill, you don't have the basic knowledge, you don't know where to buy and where to sell, you can still lose all the money in the market. Remember, we said the market is like an ocean. It's that large. So no matter the amount you think you have, you can lose it, especially when you don't know where to buy and where to sell, which we are going to be explaining in your intermediate class. But if you understand that technicalities of where to buy and where to sell, you know how to manage your risk by your lot size. Your risk management is based on your lot size. It's based on your lot size. That's the only thing that manages your risk in this market. Now you use a good lot size and you know the technical analysis, technical know-how, you have technical know-how, then you make money. And even if you're starting from $100, you're making 10 cents. That your $100, as soon as it grows from 100 to 200 to 500 to 1,000, and you understand the technical analysis, you start making from $10 to $100. It increases as your capital increases. So that's all about lot size. Lot size defines what you are using to enter the market. And this lot size also defines your risk appetite. It defines your risk management. It defines your trade management. It also protects your emotion. Lot size also protects your emotion. Imagine where you're supposed to be having 0.01 to trade. Maybe you have $100 account. You want to risk just $5. Now, under $5, you're supposed to risk, you're supposed to make use of your 0.01 to risk $5. That means you're risking 50 pips, 50-point move to risk that $5. Now, that same $5 you're risking with 0.01 for 50 pips. Imagine you are using 0.1. That means all you just need is 5 pip. That's $50 is gone. I mean, that $5 is gone. So it's different. That means once market just make 1 point move, $1, 2 point move, $2. Before you know it, where you're supposed to be risking $5, you risk more than that, and that can change your psychology and disturb your emotion because you used a higher lot size as against a small account, as against a small capital. So lot size helps control your emotion. Lot size helps protect your account. Lot size helps, in fact, your risk management revolves around lot size. Lot size. That's about lot size. So the person that asked me the question, I don't know if I've been able to clear you on that. Hello? Someone asked me a question on how much will you make if this, that. I don't know if it's MS. Who asked me that?
Okay, I am. My net is just bad, so sometimes your voice breaks.
Really?
But it's clear now.
Okay, okay. So any other questions?
No, I don't. No.
Okay. You're almost close to time. It's 1 hour 30 minutes. Precious, you're just entering and you're entering late. The class is almost over. Do we have any other question? Any other person in the room with a question? Let's attend to questions.
Sorry, please, I have a question.
Mm.
The calculation you did for the example you gave,
Mm.
you calculated with, I think, let me just give a pair like Euro GBP. Now, what of when we are talking of maybe GBP against the Japanese yen or Euro against it? You know, that one, they don't have 5 digits. So how do we do that?
Yeah, that one for Japanese yen. Now, most major currencies are 4 decimal places. But currencies that ends with Japanese yen, as in Japanese yen ends with I think 3 decimal places. 3 decimal places. Let me show you on the chart.
3
the only
decimal
difference
places after 3 digits.
Yes. The only difference is that the last one is also the pipette. The last one is also the pipette.
Can you give us an calculative example on that?
That would really take. Let me just bring something like, okay, GG. This is GG. This is GG. Let me remove this one. Okay, so you can see GJ. Oh, seriously, GJ is 152.96. Now this last one is always same defect. So it's the same thing. If you have 80.2, you just your 80 point will start from your 80 will start from this 6. So you put 0 on this 6, then 8 on this 9. This last one is always same. You can see it is 973. This one is always same. Is your pipette. Is your pipette.
Voice is breaking.
Hello? Can someone hear me?
Yes,
Yes, we can hear you now, but your network was breaking. So we couldn't hear
Okay.
you.
Okay, I said for currencies that ends with JPY. JPY is calibrated with is it on or with 3 decimal places after the decimal point. Unlike other ones that is calibrated 4 decimal places after the decimal point. Okay, let's look at it on this market watch. Now look at it. We have 5 decimal places. The last one.
I can't hear you.
Hello? Hello?
Okay, I can hear you now.
Okay. Can you hear me? Now. Right off.
No.
Hello? It's not only my side, though. Even your. It's not only mine, no. Even your voice is breaking too.
But I don't think mine is breaking.
Yes, yours is not breaking.
Well, I don't know. Maybe at a point your mouth is far from your microphone.
Sorry,
I
maybe
don't
you're
know,
using
because
earpiece.
whenever
Are you using earpiece?
Yes, I'm using earpiece.
And that's why maybe
maybe
that's why
that's
it's breaking.
because whenever you start talking, it's clear. Over time, it's just gone lost.
Okay, let's check
Yeah.
again. Is it okay?
It's clear
Now-
now. It's clear now.
Okay, now look at, let's do it from the market watch. This is our market watch. Now you can see bid and ask price. Whatever price you're seeing here is the current market price of those currencies. Now we said this is DJ. Every other currency you are seeing here is quoted in 5 decimal place after the decimal point. Whether the bid or ask price, they're the same thing, just little difference, which is the spread. This is the spread. The spread also makes use of pip and pipette. So, but look for DG. If the currently we have 152.923. So ends with JPY has a 3 decimal quotation after the decimal point. So it's the same thing. The last digit is also the pipette. The last digit on anything that ends with digit is the pipette. So if you're adding your pip and pipette, it's the same thing. Let's say we have 80. Your 80 will start, your 0 for the 80 will start from this 8 here. Then this 9 will be your 8. Then you add it up. But just know that your pipette number will be on the last digit, which is the 3rd decimal place after the 3rd decimal place after the decimal point.
Hello.
Good. Yes, can you hear me?
Hello?
Yes.
Yeah, sorry. We are taking like 100 pip. How are we going to do it?
100 pips. That means it will have to calculation is just from left to right. That means it will be from 0.
I can't hear you, please.
Hello.
I can hear you now.
Yes, it will be from 0, 0, then the 100.1. It will be 0.1. That's your encroach after the decimal point.
Okay.
Yeah, that's just it. The same thing with gold. Gold has 2 decimal points. Gold has 2 decimal places. JPY has 2 decimal 3. Silver has 2 decimal places. So that's how they are calibrated. But it's not really a problem because you can always use your cross share to check your decimal point. I mean, you can always use your cross share to check the price you want to put your stop loss or your take profit. Or you can use your cross share to calculate the price move. Is that clear?
Yes, it is.
Okay, so we'll continue next tomorrow. Today is Tuesday. On Thursday, we'll continue our class. So if you have any question, if you have difficulty in registering your account, please chat us up.
Thank you. I believe network has logged her out.
Yeah,
Or is there a way to end the class?
I think she will normally take questions.